Now, for more on the banks, let's bring in Piper Sandler Managing Director Scott Siefers. Scott, I'm trying maybe too hard to find a thread here in the different bank headlines that we've got. And I just wonder if this higher for longer situation that we have for interest rates, sure, it looks like we're getting a quarter-point cut, but that's not as much as some were hoping for. The credit crunch on the ally side, the net interest income, are we seeing the effects of that across the banks?
A little bit. So thanks for having me, John. So it is interesting. Generally the backdrop for the diversified banking space is actually pretty good. You've got revenues beginning to inflect higher, credit's holding in okay, banks are building up capital hoards. At some point we should get better lending and more consolidation. But the reality is this group's story is just always kind of riddled with fits and starts. So as anyone who's been looking at banks for a while knows, even with an improving backdrop, you're going to get plenty of days like today.
So if I'm going to buy banks broadly, tomorrow, let's say, what is it that I have to believe? Do I need to pick and choose at a micro level, or is there a reason to believe overall in the financials that you see?
Yeah, so that's an excellent question. I think a lot of investors actually buy them sort of as a basket. People tend to look particularly at the regional banks as sort of either a rate play or a macroeconomic play. So what you asked, what the kind of the backdrop or what you have to believe is, I think really you have to buy into the notion of a soft landing. Right now it looks like we're kind of threading the needle, and we'll have something that looks like we can kind of lick inflation, but not necessarily cause the economy to go into some sort of tailspin or really wreck the employment market. So if we can engineer a soft landing, that should be all right. And the reason I say that is because you should get some relief on deposit costs. Hopefully lower rates would ignite lending momentum, would ignite the capital markets, and would relieve a little pressure on credit as well.
I mean, the fact that you had Diamond and Moynihan both basically saying it's not the journey, it's the destination where rate cuts are concerned. How much does that matter, especially at a time where you're seeing this uninversion of the yield curve, which historically I would think would actually be good for the banks and things like net interest income?
Yeah, another good question. And there's an element of let's not miss the forest for the trees, I guess, if you're sort of playing for the long game. The issue, I think, is the following. Longer term, lower rates at this point are going to be better for the group for the reasons I highlighted a second ago. But that doesn't mean we won't take a step back before we take a step forward. The reason I say that is the following, and this is what sort of makes a lot of portfolio managers' heads spin. Before we get lower deposit rates that'll help net interest income, we're seeing the belly of the curve kind of come in quite a bit, and that means lower yields on loans, lower yields on securities. So your asset yields may actually come under pressure before you get relief on deposit costs. So it's, there's a lot of nuance in there that can be really confusing to investors.
And of course, Basel III and what we saw in terms of these, updated guidelines and regulations, the fact that it became a sell the news event, is it just the fact that this was already baked into the stocks, or is the shrug off overdone here?
No, so I think this was a buy the rumor, sell the news. The media started to report on late Friday after the markets had closed, at least here in the U.S., that we were going to get some relief and we would get some clarity in the next couple of weeks. So, of course, Fed Vice Chairman Barr gave a speech today that really outlined the contours of what we can expect over the course of the next couple of weeks. Indeed, I think the capital hit that the large banks will have is going to be, let's call it round numbers, about half of what we would have thought or feared a year ago at this time. So that's, in my opinion, a win for the group. So it's a good thing. Unfortunately, got kind of caught up or swept up in an otherwise kind of red day and some unfortunate timing in there.
A big theme in the culture right now, and one might argue in the economy and in politics, is the rich getting richer and the working class sort of struggling to get by. If that trend continues, looking at the financials, who does better, who does worse?
Well, wealth managers or companies with big wealth management operations come to mind immediately. So that's a good thing. And I would say, within my coverage universe, names like JP Morgan, a Bank of America, even Citi is turning around its own wealth management operation. So those are the names that come to mind immediately. More broadly, though, you can also say that we're seeing the ramifications in credit performance. For example, within credit cards, I think a lot of the banks would say that the consumer overall is actually holding up pretty well, but is really being buoyed by that upper end consumer. Whereas by contrast, the lower cohort of consumer has been under stress for a while. So thankfully, most of the large banks with big credit card operations, they tend to cater toward wealthier and higher quality clientele. So that's good, but that's not to say that there's not some underlying stress under the surface.